Should you invest in index funds or pick individual stocks? Now, if you're confused about this, I don't blame you. Warren Buffett says that most people should just invest in the S&P 500 index, but then he invests in individual companies himself. Then you have the gurus on Twitter and online saying that dollar cost averaging into index funds gives you the best possible returns because you can't beat or time the market. Now, they're wrong, by the way, and we'll get into that in a minute, but how are you supposed to decide? So on this episode of the Build, Invest, Live podcast, I'm going to break down the pros and cons of investing in index funds versus individual stocks and talk through the things you need to consider to determine what makes the most sense for you. So let's get into it. Do index funds give you the best returns? Oh man, I am kicking the hornet's nest with this one. This should be fun. There's so many comments online, Twitter, YouTube, everywhere to only buy the market. And anytime you talk about index funds versus picking individual stocks, there's always some very strong opinions on both sides. But I think if we're being intellectually honest, I think we mostly see that on the index only side, because what you will hear almost every single time is 90% of active fund managers can't beat the market. So if professionals can't do it, what makes you think that you can? And talking about professionals not beating the market, One Up on Wall Street by Peter Lynch, which is one of my all-time favorite investing books, talks about why a lot of active managers don't actually beat the market. They have restrictions placed on them that individual investors don't have. Here are some examples. Diversified mutual funds can't have more than 5% of assets in any one company, and they can't own more than 10% of a company's outstanding shares. These come from the Investment Company Act in 1940, and they're meant to prevent reckless investing by mutual fund managers. But they also limit their ability to concentrate on their best ideas, which makes it that much harder to beat the market. Plus, since they can't own more than 10% of any company, depending on how big their fund is, they're limited to only buying the biggest companies by market cap, so they don't come close to the 10% threshold. Neither one of those is a concern for an individual investor. And just for clarity's sake, I'm going to start with this. I love index funds. I think they are a wonderful invention that has allowed people of all skill levels, all knowledge levels, and all interest levels to be able to build wealth in a relatively easy way. I cannot stress that enough. They're amazing. And in a lot of ways, I'm a really good example of this because when I started out investing over 15 years ago, probably closer to 20 now, I started investing for retirement for probably the first time ever, right? And I did it index funds only because I didn't know anything and I didn't know what to invest in. Obviously, if you're investing in a 401k, a lot of times you don't have a lot of options anyway. When I looked online, saw people say, index funds are great. Warren Buffett said most people should invest in the S&P 500, which we're going to talk about that a little bit later. So I was like, yeah, sure. I continued doing that for, 8, 9, 10 years, and it worked great, right? I kept increasing my income. I kept adding to my retirement accounts, and it kept growing without me really doing anything or knowing anything. And that really is the power of index funds. Over the years, I started reading up more about investments because it was something that I was interested in, and I started learning a little bit more. And all of a sudden, we were at a point to where our financial situation was better, and we had a little bit more room to take some additional risks if we wanted to. So the point is that even in my own story, right, I've transitioned from being index only, learning a little bit more, being really interested in it. And then now, we still have a good portion of our portfolio in index funds, and we probably always will. But we have a whole other portion where we are picking individual stocks, trying to take advantage of that opportunity to get a bit better return. But the question that comes up all the time is, can you actually beat the market? And when people online tell you that you can't beat the market and index funds give you the best returns, they're lying to you. Now, they may not know that they're lying to you because they may not know that what they're saying is untrue, but it is untrue. Index funds don't give you the best returns. They give you an average market return for very little effort, very little knowledge, and very little time spent. And in the case of the S&P 500, it's averaged somewhere around 10%, maybe a little under that, for over 30 years or something, which is really good. Everyone can do that, regardless of how much knowledge, how much interest, or how much you care about stocks. That has provided the ability for just about anyone to build wealth, become a millionaire, whatever your goals are, without having to really know anything. It's an amazing invention, unbelievable. But in order to get the best returns, An index fund is never really going to be that. Just by its own definition, it's there to track an index, which is, some combination or average of a bunch of different companies. And there's a reason why so many people want to pick stocks and try to find winners and all that. And it's because when you do, the reward that you potentially can get is multiples above a normal average market return. Now, we can argue all day about whether that's skill or luck or anything in between, but that's the reason why people do it. That's why so many people want to learn about stocks and want to trade stocks. And so when I talk about this issue, it's never a question of can you beat the market or not? Because the answer is you absolutely can. And I'm just going to give you two very simple examples to show you what I mean. So the first one, McDonald's. Now, everybody knows what McDonald's is. They're a great American company. And even if you don't like the company or like the food or whatever, they've definitely been an American institution and a great performing stock forever. And if we look at McDonald's versus S&P 500 for the past 5, 10, 15, 20, 25, 30 years, any of those time frames, McDonald's stock has beaten the S&P 500 in total return. And if we just take one of those time frames, let's say 20 years, McDonald's average annual return with dividends reinvested was 16.48%, while Vanguard's S&P 500 fund was 9.94%. An average of an additional 6.5% a year over 20 years. So for $10,000 invested, you would have ended up with about $66,000 in the S&P and $210,000 plus in McDonald's. Pretty substantial difference. So that's all you had to do to beat the market, and it wasn't even really close. And McDonald's isn't some crazy tech stock. They're McDonald's. Pretty boring. So just real quick, another one, Apple. Now, we've all known that Apple's been a great company, at a minimum for the last decade, probably for way longer than that. But I think we can all agree for the last decade, Apple's been an amazing American company and an amazing stock. And if you had just invested in Apple, you would have 5x or 6x the return of the S&P over the last 10 years, 5 or 6 times. Now, of course, everything's easy in hindsight, right? It's easy to look back on a chart and say, oh, I'll just buy right there, and then I would have made the best decision ever. In reality, it doesn't work that way. But the point that I'm making is that people constantly tell you that you can't beat the market, but you can. Everybody knows what McDonald's is. Everybody knows what Apple is. No big deal. It's not a question of if you can or can't. It's a question of, are you willing to take the risk that would be required to do so? Are you willing to put in the time and effort that would be required to do so? And do you have an interest in doing so at all? And being able to answer those questions is really the difference between all these general statistics that people spit out all the time versus our own individual realities that we have to live through every day. And this is kind of what Warren Buffett's talking about whenever he recommends the S&P 500. And no one ever talks about this little caveat that he puts in there.
The trick is not to pick the right company. It's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500.
And he says it right there in that clip that most people aren't equipped, which I agree with 100%, and that he even makes mistakes too. So people take that as, well, if Warren Buffett, the greatest investor ever possibly, if he makes mistakes, then why would I ever do it? Because I'm not as good as him. But I don't think that's what he's actually saying. Because making mistakes, whether it's in investing or anything else we do in life, isn't the end of the world. It's just part of the process. It's the ultimate potential reward that we get at the end that makes it worth it. And Warren even talked about this specific thing in his annual letter this year to Berkshire shareholders. He says right here, our satisfactory results have been the product of about a dozen truly good decisions. That would be about one every 5 years or so. And then he goes on to explain how American Express and Coca-Cola were two of the best decisions they made, and that helped to really carry the rest of the gains for the company. And the important lesson is what he adds at the end. He said, the lesson for investors, the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders. So even though he makes mistakes, he understands that the winners that he does have far outweigh any of the mistakes that he's ever made, and they make it worth it. And I think the same is true for us as individuals. But the question ultimately comes back to, yeah, but the odds are stacked against you. Like, what's the probability that you're going to pick the winner, that you're going to be good at it? But that's hard for anybody else to answer for you. Like, our own individual judgment comes into play as to what we think we're good at, what we're interested in, and what we think we can accomplish. But this is true in just about anywhere else in life, too. About 90% of the people work for a company as opposed to the 10% of people who are entrepreneurs, right? And if you look at the stats on how many businesses fail, the overwhelming majority of businesses fail within the first 10 years. It's like, over 65%. So the probability says that we should just stay in our corporate jobs, right? Don't venture out and try that thing. Or let's talk about marriage. Half of marriages fail, right? It's basically a coin flip as to whether or not your marriage is going to be successful or not. So why should we ever get married? And I know I'm getting a little off track here, but the point that I'm trying to make is that stats always look daunting without context. Just because most people can't do something doesn't mean that you can't do it. The knowledge and skills and effort of an individual matter. And it's easy to see that when it comes to something like marriage or a small business, right? Like if you actually put effort into it. But the argument that people make as it relates to the stock market and how it's different than those things is they say, yeah, but the stock market is random, right? Stock prices are random. And this is this efficient market theory idea. So look, I've read A Random Walk Down Wall Street, actually multiple times. I've read John Bogle's Little Book of Common Sense Investing, which is a great book. And I've also read Peter Lynch's One Up on Wall Street, which is one of my all-time favorite investing books, as well as a bunch of other ones that talk about investing in individual stocks. And I like to do that because I want to read both sides of an opinion to help inform my own opinion, because my opinion a lot of times ends up being kind of somewhere in the middle. The idea of efficient market theory to me is just kind of ridiculous. Like the idea that the stock prices always include all information at all times and, prices are random and, you can't predict any of that. I think it's silly because at the end of the day, the stock market is a representation of human behavior, right? Even though, sure, price action on a day-to-day basis is driven a lot by algorithms now and, day traders and all that type of stuff. But in general, good companies that make money and continue to perform tend to go up over time. And poor companies that don't perform tend to go down over time. I think in general, that is true. The stock market is basically a huge experiment in crowd psychology. I mean, there are people behind those buys and sells who are making decisions and exhibiting human behavior, which is just by our own nature, imperfect. And if you think trying to predict human behavior is something that's impossible, I would just say we do it in all other parts of our life. Like just look at the examples we're already talking about. If you're out there trying to find a boyfriend or a girlfriend, you're using criteria that you have as to what you think makes up a quality person that you're interested in. And you use that criteria to find somebody. Sometimes you're right, sometimes you're wrong, but you keep on doing it. Or in this case, you pick a stock that has certain characteristics that you think make up a quality company. Because if you find a quality company, the price should go up over time. Sometimes you're right, sometimes you're wrong. But we do all those things because we think that the potential reward is worth the effort that we put in. And so those are the type of questions that we need to ask ourselves. So when it comes to deciding whether you're only going to invest in index funds or individual stocks, it's not an either or decision, first of all. Like I already mentioned, we have a good portion of our portfolio in index funds. We also have a good portion based in individual stocks that we're interested in. So it doesn't have to be either or. It doesn't have to be these extreme views one way or another. You can build your foundation with index funds just like we did. And then once you get into a situation where you have a little bit more breathing room, you have a good plan for retirement that's just kind of going and building, then yeah, you can take a little bit more risk, try something out if it's something that you're interested in doing. So anybody struggling with this, I would say that it breaks down into 4 really simple questions. Number 1, do you have a foundation set already? If not, get to stability with your finances. That will always be step 1, no matter what. Number 2, do you have an interest in learning how to value companies? Number 3, are you willing to spend the time it takes to research and monitor companies? And then lastly, are you willing to take the additional risk of picking your own stocks? And if the answer is yes to all of those, then there's no reason why you shouldn't at least try it out. Now, anytime that you talk about any stock or any ETF, there's always somebody out there that says, oh yeah, well this one that I like's better, or I could have got a way higher return just by doing this thing that I like. It's human nature. Like we all want to confirm and validate our own opinions, and sometimes we do it at other people's expense, unfortunately. But none of that stuff matters, right? Investing is not about comparing numbers with somebody else to see if I beat you or you beat me. It has nothing to do with that. It should really be about you being able to build wealth so that you can live the type of life that you want. If you have no interest on spending time on stocks, just buy the S&P 500. Keep contributing to it over the years. You're going to do great. Now, if you're in that area where you're like, well, I don't want to pick individual stocks, but I want to do a little bit more than just one index fund, then try those combinations that we talked about a couple weeks ago, where you're mixing, a tech fund with a dividend fund or some kind of combination like that. Keep contributing to that, and you're probably going to do great. There's absolutely nothing wrong with that approach. It's easy, it works, and you can go spend your time doing whatever you want to do, golfing, fishing, whatever. But if you love looking at stocks and you want to try to beat the market return with at least a portion of your portfolio, go ahead and do that. That's what I'm doing. I may beat the market and I may not, but the potential reward is worth it for me. Plus, I actually enjoy doing it. So regardless of what happens, I'm already getting something out of it. So don't worry about what anybody else thinks about what you want to do. Just stay focused and keep building the life that you actually want for yourself. Thanks for tuning in to this episode of the Build, Invest, Live podcast. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins. And I'll see you guys in the next one. Peace.